All right, welcome back, investors. We are once again speaking with Karl Cheong, Vice President and Head of ETFs over at Ninepoint Partners. And this is his second time on the channel, but it marks a tremendous event for them, which is the release of their first distributions on the HighShares lineup. So, Carl, thanks once again for joining the channel and for also sharing this event on this channel with my audience.
Thanks for having me, Jordan. Again, it's great seeing everyone. I'm really excited to talk about the covered call ETFs, our first distribution, and overall the 9 point high share suite again.
Yeah, and that's really, we want to highlight just information regarding distributions and also too, Nine Point is newer to the cover call ETF space. They're not a new fund manager in of themselves. They manage 7 billion in AUM, which is a great number here in Canada. So let's go through some of those questions that I have for you that I know the audience is going to find informational, educational, and they'll just get a better understanding of just what the high shares distributions are all about.
Oh, that's awesome. Happy to address all the questions.
Sounds good. So the first one for you, Carl, is some investors might not be aware of what actually makes up a distribution. Can you break down where the monthly distribution comes from?
It's really a good point, Jordan. People often think monthly payout is just dividends, but it's actually engineered cash flow when you're looking at these covered call ETFs. It's built from several pieces. So let's break that down for the audience. So one is option premiums. So as you know, we systematically sell calls up to 50% of the portfolio. The premium is cash, so we receive at the moment we do trade the actual security. The next one is going to be the dividends. So, and that's if they're actually paying dividends. So, take for example, Shopify does not pay a dividend, but there's certainly Canadian blue chip stocks such as Enbridge that have increased dividends for decades, or RBC, these Canadian blue chip companies that we hold and write these options on. That's one component. And then realized gains. And then lastly is the return of capital. We'll have several questions on this one. But if income from the period doesn't fully meet the demand or the stated payout, I should say, we can return a portion of the invested capital to smooth the cash flow from month to month. So I think those are all like the components that make up the distribution. And then the final tax character, like how all of these are allocated and when it gets counted, a dividend or capital gain is only at year end.
I actually think that's a really good point. I think in some of my prior videos, people are asking, what is the MER of certain funds that are new, but they need to have one tax year under their belt to actually see the full MER, not just simply the management fee. Just keep in mind the MER for those who are newer is for the most part, all the expenses that make up running the fund. Maybe trading expenses may not be a part of that. Sometimes it is, sometimes it isn't. I've seen it on different pages. They do include it, but again, there could be some uh, differences in whether what's included and what's not included in that. But that's essentially what the MER is. That's your leverage costs, management costs, and other marketing costs as well. That's how I think investors could maybe think of the MER.
No, I think that's a great clarification. You don't want to be surprised at how this is all built in. Just a note on the leverage, though. So the modest leverage that we're utilizing, which is close to like up to 25%, but it's closer to 20%. That's part of the portfolio design, but it's not one of the direct cash sources of the monthly payout.
Hmm.
So that's very, very important. We're not taking debt and then distributing it to fund our distributions. And I think that's going to be an important factor as well.
Actually, you know what? To your point about leverage, and I'm actually kind of curious myself, is now the way that the leverage is used, do you only use it for like, do you write options on the leverage, that portion that you use, or is that kind of more or less used more for to allow the fund to say grow? Because as we know,
Mm.
cover calls cap upside. So is that can that leverage be used in such a manner to just help say stabilize NAV and potentially grow, or do you just do it one for one the way you write on the portfolio that's unleveraged versus the one that is the portion that is leveraged? Is it just a one for one ratio? It's the same.
The way it works is that, to your point, you take, say you have $100.
Mhm.
We're borrowing 125, like, so we're buying 25. So the end amount becomes 125. From that 125 base,
Mm.
we're then writing options on that portfolio. So what it does is generate more income, more yield for the end investor, because you're not just writing on the $100 of
Right.
portfolio securities. We're now writing on a higher absolute base on that front. So, the leverage, as we talked about, helps boost yield, helps boost return as well. And you know what the really cool part about the strategy, when you take a look at it, it takes leverage up to 20%. And then we're writing covered calls. So you have one factor that's boosting yield, boosting returns. That's the leverage. And on the other side, of course, it's a dual-edged sword, in that if it's coming down, the leverage is going to work on reverse. No, but in this case, you're saying you're boosting yield, you're boosting leverage, plus you have these covered calls that often dampen the return. And so up to 50% allows us to say, okay, if we're using leverage of up to 20% and we're writing 40%, that actually provides a closer one-to-one exposure to the underlying stock, which is basically what you want, plus the actual distributions that we're paying out monthly as well. So you're getting paid while getting exposure to the stock.
Yeah, I've noticed I have noticed that I guess when you guys break down the holdings and you can see you can see that all the underlyings add up to that 125 mark, and that seems to be pretty common across the industry. Same with around 25% leverage. I mean, if you are newer to cover call ETFs and maybe are a little bit spooked by leverage, this is actually quite common. It seems like everybody utilizes it, especially here in the Canadian space. Americans probably are going to start to utilize it more so for investors who want something a little bit more stable instead of just wanting explosive yields that are 60% plus. Let's just say. Um, so the next question I have for you, Karl, is can you explain what keeps a payout sustainable and how sustainable is the current distribution in the current market environment across all the various high shares that you guys have?
Right. So two parts to that question. Keeping the payouts sustainable. I feel sustainability is really at the heart of our process. So what we're trying to do here is, one, match inflows. So you take the premiums that we talked about, the dividends, the realized gains, with the payout target. And so we cap writing, as I mentioned, up to 50%, and then adjust the strikes and tenors with the volatility that we're seeing in the marketplace. We're also, I can tell you just from operating these type of strategies for the first month or so, we're currently taking a look at the sustainability and reviews. So the portfolio manager, Colin Watson, has been working on this strategy with me, and we're constantly talking about the sustainability, the current market environment. Fortunately, we've launched into an environment where the stock market has gone up over that period, but we're also taking a look at the vol and on the various names, and they could be very different depending on the experience. So we're constantly reviewing if the income weakens, and then what to do. Should we right size before we overpay? That's very much top of mind in our process. And then again, we're using modest, carefully managed leverage as part of the total return design, but we never promote it as a guaranteed income booster as well. So the guiding principle for the Ninepoint HighShares suite is, we're going to earn what we pay and can sustainably pay out. We're going to try to protect the NAV and deliver competitive, responsible cash flow to investors who take a look at our product.
Yeah, I think many investors will, they certainly take NAV stability quite seriously. Not everybody is interested in, say, the 4% rule. They do want to protect their principal, have their distributions pay their lifestyle. I certainly hear from many investors when it comes to that. Next question. Can you explain to investors how cover calls help fund distributions and what do investors give up?
So, really good segue there in terms of how it could payouts work in this make to keep it sustainable, how we do things on that front there. So with covered calls, they're really an engine to the strategy. We own the stocks, as you know, we sell call options as part of them. This gives us immediate premium income which flows straight into the fund and supports the monthly payout that we're trying to deliver. So the trade-off, it's really important, the pros and cons of both. If a stock rallies past the strike price, we're capped on some of those upside shares. Now, what we've talked about in our first interview is that we're actively managing that. So we're writing slightly out of the money up to a certain level of 7%, and we're laddering these strikes. And so what that allows us to do is take advantage of the upside, even on the portion that we're writing. So at the 40%, you're going to have some covered call writing to generate, but you're also exposed to the stock at 60%. So that's really one of the trade-offs that we're willing to make in order to deliver income there, but we can still manage the upside and take advantage of it tactically. So we're going to still collect the dividend, the option premium, but not the extra run up above the strike. That means it's going to be called. And the downside, the risk remains. The premium just cushions the downside if you see it in the stock at any point.
I see. Very good. Speaking about just the health of distributions, what factors would Ninepoint consider a distribution cut or increase?
So the cut. One of the most common questions we're getting initially is like, will the payout stay the same? How smooth it would be? The honest answer is we monitor it carefully and we adjust on the underlying economics change. As I mentioned, volatility is what drives a lot of the distributions. But when it comes to a cut in the payout, and we've seen it, like your audience invest in various products from different competitors. Many have had to cut distributions depending on the actual stock or the portfolios, but that's just a function of the market, right? The volatility month to month. So the first one in terms of a cut, what would catalyze that is maybe sustain lower volatility. Option premiums are the single largest driver of the income. So if markets become very calm, even on very popular stocks, we talked about MicroStrategy, etc., for an extended period, option prices will drop and the income we generate will shrink on that front. Second one is the dividend cuts from the underlying companies. So we rely on dividends of blue chip Canadian stocks in our suite, the Ninepoint HighShares suite. So names like BCE or Enbridge or RBC all pay dividends. And if they were to cut their distributions or reduce their dividends, that lowers the cash flow we can pay out, another component. And then if there's a persistent reliance on ROC, so if we're topping up with return to capital too often or too high a level, and we're monitoring that, as I mentioned, on a real-time basis, it's a sign the payout isn't fully supported. And our philosophy at that point would be to right size before the NAV would erode. Very much so on that front. So those are the three. The other one I'll talk about is like, rising borrowing costs. I think that's clearly it's eating into the margin there. We're using modest leverage. We're actually seeing the opposite, as we're going to talk about, as the Bank of Canada is cutting, but rising borrowing costs is one of the other factors. And then if you're seeing like equity drawdowns for very, very long periods, it's a sharp declines, it stays down, the stock base actually shrinks, it's reducing maybe its dividends and its notional side, of all the calls we can write on. And I think that's another scenario, but we haven't seen that in the last several years. We'll see how it goes.
Yeah, we sure will. Now, With Ninepoint is currently offering a 0% fee waiver for what is that, roughly the next 5 months or so, until February of 2026. How does that flow through to the end investor not paying that management fee?
Cost matters, right? We certainly knew this when we entered into this space, and understanding that the Ninepoint HighShares would have a real cost benefit, as we have a 0% management fee until February. As you know, that's a bit of a fee waiver and an incentive to take a look early days. That eliminates, what that does essentially is eliminate fee drag. So more of the fund's cash flow stays with investors.
Hmm.
So after the waiver ends, though, the ongoing fee is going to be 29 basis point management fee, I should say. Still one of the lowest, if not the lowest, among Canadian covered call single stock ETFs. And so cost is really one of the easiest factors over time. You think back to the inception of the ETF industry, it was based on cost and transparency and liquidity. Cost is one of the easiest factors for investors to somewhat overlook. In an income focused product such as our Ninepoint HighShares, fees also eat directly into the cash flow the fund can distribute. So that's why we've launched these HighShares, these Ninepoint HighShares at 0% management fee. Really great experience for the end investor. And then afterwards, a modest fee of 0.29. So you're able to keep more of what you're earning through the portfolio.
Currently, the HighShares products look to be, well, it's stated they're monthly payers. Can you easily change these to bi-weekly payers, and might future launches include payouts at a higher frequency?
It's been only a month, and it's fairly often whether we're getting this question whether we can pay biweekly instead of monthly. It's a natural question, I think, because a lot of investors think in terms of paychecks. Very much the fire community that we're seeing that, and may want their ETF to line up with that rhythm. So the short answer for the existing products is no, unless not at least under the current structure. These ETFs are specifically designed and disclosed to pay monthly distributions, and that's governed by our prospectus. So the distribution frequency is part of the prospectus. It's a formal, regulated attribute of the fund. So what that can mean going forward, though, it's not that's impossible, but it's certainly something that we could look for future project launches, or if it makes sense with this existing suite, we can go to unit holders and ask them if whether a change like this makes sense, and offer that. But that's certainly on the radar. There's even, as you mentioned, some products that are offering weekly in the United States. So I believe, just crystal ball here, is Canadians will go in that direction eventually. But operationally, now going back to some of the conversation we had, Jordan, about this, is that monthly is a standard here in Canada because it lines up with most investors how they plan income. But I think it's evolving, and could it happen? Absolutely, yes. You're already seeing some of the providers respond, and that's something we think that could be part of our future product development plans.
Now, Carl, for the next question, how should an investor think about what might be right for them in regards to picking a 9 point high share single stock cover call ETF versus the all in one, the wrap version?
Really good question, Jordan. We built HighShares really the lineup with two simple ways to invest, because most people approach income in different ways. The first one is the single stock HighShares ETFs, as you alluded to. These are funds like RBC, RYHI, Shopify, SHHI. Each one basically owns a single well-known Canadian company, just like you would in a regular brokerage account. And what we do is we layer on a disciplined covered call strategy that we've been talking about throughout. They're really great already if you have a strong opinion on the name. Maybe you love RBC because of the dividends, the stability of the firm, or Enbridge for its pipeline infrastructure, as an example. This is a way that you can just generate more cash flow while you hold it. They're also useful for financial advisors as well, looking to build customized portfolios, and you want to overweight certain sectors or companies while harvesting that option premium. The wrap, it's our bestseller so far. It's the one ticket wrap portfolio. ECHI really stands for Enhanced Canadian High Income ETF. It's basically a basket that blends all the single stock high shares ETFs into one ticker. So you get covered call overlays on the underlying names because we're investing in the underlying single shares. And you don't have to decide which company to pick or how much to allocate to each. It's a pre kind of wrapped, diversified across our lineup.
I think so. I think many seem to really like to go for that diversified product, even in a concentrated format. However, the nice thing is about the wrap ECHI is that it does cover so many different sectors across the Canadian economy. I think investors will be attracted to it, and I think that's probably why you say it is your best seller. Karl, I really appreciate the time coming onto the channel to talk about the HishShares lineup, their first distributions. So congratulations on that event, and hopefully we can get you back on the channel sometime soon.
It was a lot of fun. Thank you, Jordan. Talk to you soon.